by considering or taking example of our business, we can well understand that how much tax we will be paying depending upon the level of our business. Fiscal policy also impacts the amount of taxation on future generations. The government spending that leads to greater deficits means that taxation will eventually have to increase to pay interest. Okay, so it means that fiscal policy also determines the future uh, of our business, or we can say the taxation of the future generation. How? Because the government spending, today's spending of government, or the government spending of this year or this month will decide that whether it will lead to deficit spending in future or whether it will lead to stimulus spending in future. So depending on that, of course, the contractionary or the expansionary fiscal policy will be implemented. Okay, depending upon today's spending, it will be decided that in future whether the contractionary fiscal policy will be implemented or expansionary fiscal policy will be implemented. Unemployment rate. A major objective of fiscal policy is to minimize the unemployment. Again, the same thing that we discussed in first point. For example, the government can lower the taxes to put more money back in consumers' pocket. Okay. Unemployment rate will be reduced if the fiscal policy will be implemented in a right manner. For example, the government will lower the taxes, the consumers will start paying lesser than before. Okay, so in this way, the government is aiding the people, aiding the citizens by saving their money. As such, the consumers have more money to spend, and companies may face increased demand. Okay, means the consumers have to pay more money. That means that if the taxes will be increased, the consumers will be paying more money, and the company may face increased demand. Consumer have more money to spend because the consumer has saved the money by paying the little taxes. Okay, so now the consumer has more money to spend, and the companies may face increased demand. Why they will face increased demand? Because the taxes have been lowered. Now the people will be getting the products in the lesser prices, so that is why the demand will be increased. With increased demand may come additional production tasks for the companies to complete, and the businesses can respond by creating more jobs and hiring more employees. With proper fiscal policy in place, a low unemployment rate may gradually increase. Okay, so now the consumers have more money in their pocket, the demand of the products will increase. So due to the increased demand, there will be increased production tasks. Due to the increased production tasks, there will be demand of increased working or increased labor. Okay, so to meet with that increased labor, the businesses, the institutions will start hiring more and more people. Okay, so due to this, of course, the unemployment rate will be reduced, or the employment rate will be increased. Okay, next is the impact of monetary policy. Now, let us see the impact of monetary policy. We have discussed the impact of fiscal policy, and now comes the monetary policy. The transmission of monetary policy describes how the changes made by the Reserve Bank or the central bank to its monetary policy settings flow through to economic activity and inflation. Okay, so basically, the transmission of money from the central bank to the other banks or other institutions basically describe that how the economic activity has been going on within the country and how the inflation is going is happening or going, whatever word we use. This process is complex and there is a large degree of uncertainty about timing and the size of the impact on the economy. Okay, this process is very complicated. Why this process is very complicated? Because first and foremost, the monetary policy has a limited control. Secondly, the government is also included, or the government has also will also play its part in stabilizing the economic activity within the country. So that is why it is a complicated process. Okay. So simply, the transmission of the money can be summarized in two stages. Changes to monetary policy affect interest rates in the economy, and the changes to interest rates affect the economic activity and inflation.
Ma'am, I'm
Yes.
sorry to interrupt you in this middle. For fiscal policy, we have learned it's not that's called job opportunity for this impact. But for in monetary policy, since they are also part of central banks and focuses on the money supply. So, ma'am, why in this case, like in the government also stabilize the economy, why is it a complicated situation, ma'am? If you just explain that.
Actually, the central bank is part of government. Okay, the governments are not part of the central bank, or you can say the government basically owns the central bank. Okay, so therefore the central bank is dependent upon government, but government is independent. So whenever the government is implementing the fiscal policy, it will create the job opportunities um, independent of what the central bank is doing in the country. While because and the other reason is because the central bank is just related to the circulation of money among the banks and institutions. So therefore, central bank cannot create job opportunities because its purpose, its main aim is to decide about the interest rates and the circulation of money. Okay, it cannot interfere in taxation. It will not interfere in spending. The government will decide what kind of spending will be done depending upon the economic state of the country. Okay, so therefore, the central banks are not involved in creation of job opportunities. In fact, if the job opportunity in the central bank is created, even then the central bank is not involved. It will be decided by the government that now a post of two cashiers are required for the central bank. The central bank will no doubt uh, intimate the government about this vacation or this requirement. Okay. But government will decide whether the central bank requires. This is just an example. Of course, only one cashier is not present in the central bank, but I'm giving you an example. Okay, the government will decide whether the government can hire another cashier in the bank or not, another manager in the bank or not, because the money is eventually coming from the economic status of that economic activity of that country. Okay, so central bank is owned by the government. It is part of the government. So that is why the central bank cannot independently create any job opportunity. Okay, okay. So the uh, transmission can be summarized in two stages. Changes to monetary policy affect the interest rate in the economy. Okay, whenever the changes will be brought about in the monetary policy, the interest rates in the economy will be affected, or whenever the interest rates in the changes to interest rates affect the economic activity and inflation. Okay, now the level one is monetary policy. Changes in the monetary policies are done, it will affect the interest rates in the economy. The stage two is the changes in the interest rates will affect the economy and the inflation. Okay, these are the two stages. The first stage, monetary policy is determined by the Reserve Bank Board, a Reserve Bank, central bank. Okay, the primary and the conventional tool for monetary policy is the target for the cash rate, but other tools have been included: forward guidance, price, and quantity targets for the purchase of government bonds and the provision of low cost fixed term funding to financial institutions. The main aim that because the monetary policy is implemented by the central bank. So of course, the first tool, the main tool that the monetary policy will target is the cash rate. Okay, the currency rate. The other things that can be included in this first stage. What is the first stage? The first stage is changes in the monetary policy will affect the interest rate in the economy. Okay, so the first tool is the cash rate, the currency rate. The other tools are the price and quantity targets for the purchase of government bonds and the provision of low cost fixed price term funding to financial institutions. Okay, so this means that monetary policy not only affects the currency rate, but also the price of the currency means that whenever you are going to change the local currency into the international currency, what will be the price? Now that price is dependent upon the economic status of that country. Usually the nowadays what we are following, the third world countries are following our currency rate. The price of our currency is determined by the rate of a USA dollar. Okay, so this is
Sorry, ma'am. Can you repeat again? Prices is dependent upon the. I didn't understand that.
the price is dependent on the economic status of that country. If the country is going through inflation, of course, the price of that country's currency has been decreased in the time of inflation. Okay, and usually what measure decides the price, or you can say what is the standard with which we will compare our currency and will decide the price of the currency. That for third world countries it is USA dollar. Okay, so with USA dollar we will compare our currency, and depending upon our the inflation, higher inflation, lower inflation, or smooth inflation in our country, we will decide the price of our local currency. And most of the times, when the country is going through a higher inflation time, the price of the local currency has been decreased. Okay. And another tool is the purchase of government bonds, the provision of low cost fixed term funding to financial institutions. And the third thing is that low cost fixed term funding. Okay, means that financial institutions funding to financial institution. In now this can be done in any form. For example, let's take an example. Okay, for example, a country is going through a tough time. There is high rate of inflation in the country. The price of the local currency has been decreased. Now, the government is taking aid, financial aid, low cost aid from the citizens of from its own citizens. Okay, for example, if the government needs to build a school, but the economic status is very poor, higher inflation rate, what the government will do, it will start a survey, or it will start a scheme. They will start requesting the citizen to donate a few pennies, a few rupees, a few dollars to the government's account in order to build a government school for a specific area. Okay, so these are a few tools that are affected by the implementation of monetary policy. In the first stage of transmission is about how the changes to setting for these tools influence the interest rates in the economy. Okay, so in first stage, when the changes in the monetary policy has been done, it will be affecting the interest rates in the economy of that country. Okay, so it means that in first stage of transmission, it means that in first stage, the changes in these tools it will influence the interest rates in the economy. Okay, the cash rate is the market interest rate for overnight loans between financial institutions, and it has a strong influence over the interest rates, such as deposit and lending rates for households and businesses. The Reserve Bank's other monetary policy tools work primarily by affecting longer term interest rates in the economy. Okay, now what is the cash rate? The cash rate is the market interest rate for overnight loans between financial institution, and it has a strong influence over the other. Okay, all right. So now you can say these are some ways of affecting the economy, and these ways are usually adopted by the institutions themselves. For example, the cash rate. Now, what is the cash rate? Cash rate is basically the overnight loan that one or two institutions, and that two financial institutions, are getting and taking from each other. Now, this loan has a strong influence over other interest rates, such as the deposit and lending rates for households and businesses. For example, a bank takes loan from the central bank. Both of these are financial institutions. Okay. Now, a local bank takes an overnight loan from the central bank. As a result, the consumers of that local bank will be affected, because now that local bank will charge different interest rates over deposit and the lending rates for households and businesses. Let me give you a practical example. I borrowed money from a bank in 2022. Okay, after 6 months, that bank borrowed loan from the central bank of our country, and as a result of which, that local bank increased the interest rates on the money, and it resulted in lots of increase in the monthly installment that I need to pay back to that. Okay, so this is known as cash rate. The cash rate is basically the overnight loan that one financial institution will take from the other financial institution, and it will result in different interest rates over the deposit and lending rate for households and the businesses. All right. The Reserve Bank's other monetary policy tools work primarily by affecting the longer term interest rates in the economy. So the cash rate, the price of the currency, you can say, okay, so this is something that will directly impact the interest rate, but the other tools, they will also impact the interest rates, but in longer term. So this is the first stage. The first stage is the changes to the monetary policy that will affect the interest rates in the economy. Okay. Now the other stage is the changes in the interest rate that will affect the economic activity and the inflation. Okay. Now we are continuing the first stage. While monetary policy acts as a benchmark for interest rates in the economy, it is not only the only determinant. Other factors, such as conditions in the financial markets, uh, changes in competition, and the risk associated with different types of loans, can also impact interest rates. As a result, the spread or difference between the cash rate and other interest rates varies over time. But other factors that will affect the financial, growth, or the economic status, or the economic activity, or indirectly, we can say that interest rates. These include the competition in the market, the types of the loans, the risk associated with these types of loans. Okay, so all these things will eventually affect the interest rates. So as a result of which, the difference between the cash rate and other interest rates, they will varies over time. Okay, because your cash rate, it keeps on changing and changing. As a result, the interest rate will also keep on changing. The second stage of transmission is about how the changes to monetary policy influence economic activity and inflation. All right. So we are done with the changes in the monetary policy that will affect the interest rates in the economy. Now, how these interest rates change will affect the inflation. Let us see. To highlight this, we can use a simple example of how the lower interest rates for households and businesses affect aggregate demand and inflation. Okay. Of course, the higher interest rates have the opposite effect on demand and inflation. Interest rates will be higher. Of course, the inflation will be higher. it will be reduced demand of the products or utility, household items or commodities or anything else. Okay. So basically, the interest rates will determine how the inflation will be affected. Aggregate demand. The lower interest rates increase the aggregate demand by spending, by stimulating.
Ma'am, sorry, I didn't understand the second stage. Can you repeat again? What's exactly
Okay.
like meant
Mhm.
exactly?
Why
Sorry,
is it?
ma'am.
No, no, it's okay. It's okay. The second stage is quite easier. Just one thing has been described in this. Increased interest rates means increased inflation. Reduced interest rates means reduced inflation. Because whenever the inflation will be increased, the economic activity will be lower. It means that now the government will increase the interest rates. The government will increase the cash rate. Okay. So what you need to learn in the second stage is that the higher interest rates will lead to higher inflation, or vice versa. The higher inflation will end up in higher interest rates, and the lower interest rates means the inflation is either smooth or the inflation has been lowered. Okay. So it will end up, or it will be a result of lower interest rates. This is as simple as it is. Now, is it clear to you, or do you have still confusion?
No, ma'am. So for in that case, like interest rates will be higher, which will increase the inflation. So government will increase the cash rates, and lower rates will reduce the inflation. So which will go with it would result into a lower inflation, like the demand and all, like lower interest rate.
Exactly, exactly. So this is only explained. Okay, aggregate demand. Lower interest rates increases aggregate demand by stimulating the spending. Okay, now the lower interest rate, of course, the interest rate is lower, the inflation is lower, the demand will be increased, so the government will start spending. But it can take a while for the supply of goods and services to respond, because more workers, equipment, and infrastructure may be required to produce them. Because of this, aggregate demand is initially greater than aggregate supply, putting upward pressure on prices. Okay, so no doubt, lower interest rate means that the economy is good enough, the economy is smooth, the inflation is lower. But of course, it will result in increase in demand of the products and services. Now, to meet with that demand, more workers will be required, equipments will be required, and for that, of course, the hiring should be introduced. More hiring should be done. Okay, so as a result of this, aggregate demand is initially greater than aggregate supply. So putting upward the pressure on prices. Okay, this is a strategy. If you do remember, we studied this strategy in supply and demand chain. That ideally it should be done that whenever there is a greater demand, whenever the economy is smooth, there should not be increase in prices. But what the producers do, they start increasing the prices of the product because they know the demand is high. If we go to the earlier stages, why the demand was increased? The demand was increased because the taxes were reduced, the prices were reduced. Now the producers are doing something different at their end. They are increasing the prices, although the taxes have been reduced. Okay, so this is another thing, another confusion, or you can say another opposite channel. On one end, the taxes have been reduced, but at the end of this channel, the producers are increasing the prices because they know that there is a bigger demand of their products. As the businesses increase their prices more rapidly in response to the higher demand, this leads to higher inflation. See what happens? The government has reduced the taxes, but because we, the people, the citizens, have increased the prices, again we are taking our country towards the higher inflation rate. There is a lag between changes to monetary policy and its effect on economic activity and inflation, because households and businesses take time to adjust their behavior. So some estimates that suggest that it takes between 1 to 2 years for monetary policy to have its maximum effect. However, there is a larger degree of uncertainty about these estimates because the structure of the economy changes over time and economic conditions vary. Because of this, the overall effect of monetary policy and length of time it takes to affect the economy can vary. All right. Now, the inflation expectations. Inflation expectations also matter for the transmission of monetary policy. For example, if workers expect inflation to increase, they might ask for the larger wages increases to keep up with the changes in inflation. Higher wage growth would then contribute to higher inflation. Okay, so higher inflation means that now the workers are unable to cope up with the higher inflation rate. They are unable to fulfill their daily requirements, so they will ask about the higher wages, and directly these higher wages will further increase the inflation. By having so the only way to cope up with the higher inflation rate is to reduce the taxes and to keep the prices at the similar level. By having an inflation target, the central bank can anchor inflation expectations. This should increase the confidence of households and the businesses in making decisions about saving and investment because uncertainty about the economy is reduced. Okay, so to fight back this higher inflation rate, the central banks they usually provide offerings and deals for the businesses and even the households to aid the citizens indirectly. Okay, so in this way, the central bank will also get the benefit while the citizens of the country are also getting benefit from the central bank in order to fight with the higher inflation. Okay, channels of monetary policy transmission, saving and investment channel. Okay, what are the channels of monetary policy transmission? How the transmission of money is done? Monetary policy influences economic activity by changing the incentives for saving and investment. This channel typically affects the consumption, housing investment, and business investment. Okay, this is a way of saving the money in banks and then fulfilling your housing investment, your business investment, and your consumption of daily life. Okay, lower interest rates on bank deposits reduces the incentives households have to save their money. Okay, by lowering the interest rates, banks are usually enabling you to save the money in your bank accounts. Instead, there is an increased incentive for households to spend their money on goods and services. Okay, so this is another way, another offer given by the banks. If you start investing your money on goods and services, the bank will provide you with loans, and these loans will be of lower interest. Okay, so bank is also not at loss, and besides this, the bank is aiding you. Lower interest rates for loans can encourage households to borrow more as they face lower repayments. Because of this, lower lending rates support higher demands for assets such as housing. Okay, sometimes the banks also offer you with the loans to not only for your businesses and not only for the households, but also to cope up with the higher prices of the properties, the housings, the assets. Okay, so you can take loan from the banks and you can purchase your own property. Lower lending rates can increase the investment spending by businesses on capital goods like new equipment or buildings. This is because the cost of borrowing is lower and because of the increased demand for the goods and services they supply. This means that returns on these projects are now more likely to be higher than the cost of the borrowing, helping to justify going ahead with the projects. This will have a more direct effect on businesses that borrow to fund their projects with debt rather than those that use the businesses owners funds. Okay. Now this is another offer. Okay. Lower lending rates. Now lower lending rates means that you can increase the investment spending, especially if you are owning a business. In this way, you are taking loan from the bank. You are spending that loan on your business, and you are returning that loan by the growth of your business. Okay, you are not using your saved money. Your saved money is still in your bank account. You are taking the loan from the bank. You are spending it on your business. Now, when your business is producing the money, multiplying the money, then you are returning the loan to the bank. Okay, so this is another good way. And again, both the consumer and the bank, both of them are getting profit. So this is the first channel is saving and investment channel. Okay, next channel is cash flow channel. Okay, we have one, two, three slides are remaining. If I will be unable to complete these slides on time because due to my laptop issue, we unfortunately wasted our first 12 to 13 minutes. Okay, so in case if I'll not be able to finish the slides, inshallah, in the next class I will continue from these slides and then we will start our new lecture. Okay, the next channel is
Okay, ma'am.
cash flow channel. Monetary policy influences the interest rates, which affect the decisions of households and the businesses by changing the amount of cash they have available to spend on goods and services. This is an important channel for those that are liquidity constrained. For example, those who have already borrowed up to the maximum that banks will provide. Okay, now the cash flow channel is for those people who have already taken the loan from banks and they are unable to take more loan or they are unable to return the complete loan to the banks. A reduction in lending rates reduces interest repayments on debt, increasing the amount of cash available for households and businesses to spend on goods and services. Okay, in this method, in this channel, the interest rates are reduced, or you can say one installment has been divided into two. For example, if you need to return a monthly installment of $30, now the bank has reduced your monthly installment to $15. In this way, the stress, the financial stress on you has been lowered. Now you will be able to return the monthly installment along with you have some saved money in your bank account to fulfill your daily requirements. For example, a reduction in interest rates lowers the repayments for households with variable uh, mortgages, leaving them with more disposable income. At the same time, a reduction in interest rates reduces the amount of income that household and businesses get from deposits, and some may choose to restrict their spending. Okay, so again, the same thing has been explained in different wording. These two affect these two work in opposite direction, but a reduction in interest rates can be expected to increase the spending in Australian economy through this channel, with the first effect larger than the second. Okay, so there is a little bit difference in the second sentence.